Definition and significance of ability to repay. ATR. What is ATR? The ability to repay, ATR rule, is a legal requirement that obligates mortgage lenders to make a reasonable and good faith determination that a borrower can repay their mortgage loan based on verified financial information. Lenders must evaluate and confirm that borrowers have the income, assets, creditworthiness, and stability needed to afford the mortgage, not just at closing, but for the life of the loan. This is more than just good practice, it's federal law. Where did ATR come from? The ATR requirement was introduced under the Dodd-Frank Wall Street Reform and Consumer Protection Act in response to the 2008 housing crash, which was caused in part by lenders issuing no-doc and subprime loans to unqualified borrowers. The rule is administered and enforced by the Consumer Financial Protection Bureau, CFPB. Result: mortgage lenders must now verify and document key financial criteria before approving loans. Gone are the days of stated income or no income verification loans that contributed to widespread foreclosures. Why ATR matters to buyers and agents. Protects buyers. ATR prevents borrowers from unknowingly taking on loans they cannot sustain, reducing the risk of foreclosure and financial hardship. Stabilizes the market. By ensuring responsible lending, ATR promotes long-term stability in the housing industry. Guides real estate agents. Knowing whether your buyer is likely to qualify under ATR helps you set realistic expectations, avoid wasted time, and stay compliant with your fiduciary duties. Commissioner's Standard AAC R4-28-1101I. Licensees must exercise reasonable care when communicating material facts. A buyer's financial readiness, including any signs that they may not meet ATR standards, is considered a material fact that must be handled with diligence and care. Key factors. Lenders evaluate under ATR. To satisfy the ATR rule, lenders must assess the borrower's full financial picture, not just credit score or down payment. Let's break down the main categories they review. Income verification. Documents reviewed: pay stubs, W-2s, 1099s, tax returns, and employment verification letters. Example: a salaried teacher provides 2 years of W-2s and her last 30 days of pay stubs. A freelance photographer submits 1099s and full tax returns. Assets and reserves. Lenders review bank accounts, retirement accounts, and investment portfolios. Purpose: to verify the borrower can afford down payment, closing costs, and reserve funds, e.g., 2 to 6 months of mortgage payments. Credit history. The lender reviews the borrower's credit report, looking for consistent repayment, open trade lines, and any derogatory marks like late payments or collections. Debt-to-income ratio, DTI. Front-end DTI, mortgage payment divided by gross monthly income. Back-end DTI, total monthly debts, including mortgage, auto loans, credit cards, divided by gross income. Typical max DTI, 43% for most qualified mortgages, QM, although some lenders allow exceptions. Example: a buyer earning $5,000 a month with $2,150 in total monthly debts would have a 43% DTI. Employment stability. Lenders prefer 2 years of continuous employment in the same industry. Gaps in employment may require explanation. Income consistency is key, especially for self-employed or commission-based borrowers. AAC R4-28-1101A. Agents must deal fairly and honestly with all parties. If a buyer discloses they've been unemployed for 6 months and just started a new job, that may impact their ATR status, something that should be discussed with their lender before submitting offers. Case studies and real-world scenarios. Let's examine a few typical buyer profiles to illustrate how ATR affects loan approval. The strong borrower profile. Sarah, a nurse with 5 years of job history, a 720 credit score, and a 10% down payment saved. Result: easily qualifies. She meets all ATR requirements and is quickly approved for a conventional loan. Agent's role: provide lender referrals, coordinate pre-approval, and proceed confidently with showings and offers. The marginal borrower profile: Jake is self-employed with fluctuating income. He has decent credit, 680, but no savings and a 47% DTI. Result: may still qualify, but lender recommends paying off a small loan and saving more for reserves before final approval. Agent's role: encourage Jake to meet with a lender early. Avoid writing offers until financing looks more secure. Document all conversations and recommend financial counseling without offering specific financial advice. The denied applicant profile: Emma has good income but only worked her current job for 3 months after a career change. She also has $35,000 in credit card debt and a 620 credit score. Result: denied due to lack of job history, high DTI, and poor credit. Agent's role: empathize, suggest Emma works with a lender or financial advisor, and avoid continuing home searches until she's ready. ARS, paragraph 32-2153A3. Misrepresentation during a transaction, like falsely presenting a buyer as qualified when you know they aren't, can lead to license suspension or revocation. Know your limits as an agent. Real estate licensee's role: as a licensee, you are an advisor and facilitator, not a loan officer or financial planner. It's important to understand your appropriate boundaries. Help clients prepare. Provide a list of commonly required documents: pay stubs, tax returns, bank statements. Suggest gathering materials before starting the home search. Refer to qualified professionals. Recommend licensed mortgage brokers, bankers, or lenders. Offer a few referrals to avoid steering. Avoid offering financial advice. Do not calculate loan amounts, interest rates, or DTI. Do not interpret credit reports or tax returns. If unsure, always say, "Let's check with your lender." AAC, R4 28 1101B. Licensees must not perform services outside the scope of their license. Giving underwriting opinions or financial advice may cross that line. Arizona statutes and commissioner's standards. Understanding your legal duties is essential when dealing with ATR and financing matters. Regulation application. AAC, R4 28 1101A. Deal fairly and honestly with clients and other parties. AAC, R4 28 1101B. Do not perform services beyond your license, e.g., underwriting, loan calculations. AAC, R4 28 1101I. Use reasonable care when communicating material facts, e.g., buyer job loss, loan risk. ARS, paragraph 32-2153A3. Misrepresentation during transactions may result in license denial, suspension, or revocation. Compliance and risk management. Handling financing topics with care protects you and your client from liability. Document conversations. Keep notes in your file when clients discuss financial matters. Note referrals made to lenders or mortgage brokers. Disclose lender relationships. If referring a lender from your brokerage's in-house team or affiliated business, disclose that relationship clearly per RESPA guidelines. Stay informed. Lending guidelines can change frequently. Stay in touch with your preferred lenders and subscribe to updates from the CFPB or Arizona Department of Financial Institutions. Knowing your role, staying compliant. Understanding the ability to repay rule helps agents guide buyers responsibly while staying within the scope of their license. Remember, lenders are responsible for verifying the borrower's financial readiness. Agents are responsible for supporting, not underwriting. Misrepresentation or careless handling of financial disclosures can result in serious legal consequences. By working ethically and professionally, you protect the transaction and your license.